Welcome to the Deep Dive by OVTLYR, where we uncover the market's hidden trends and give you the edge you need. Head on over to OVTLYR.com right now to save time, make money, and start winning with less risk today. Now let's jump right in.
Welcome back, everybody, for another Deep Dive. This time, we're tackling something I know a lot of you are probably thinking about, especially with the election results still so up in the air, right?
Right.
What happens to the stock market after a U.S. presidential election?
It's a big one.
I mean, I don't know about you, but I remember back in 2020, I was like, oh my gosh, is my entire portfolio about to just tank?
Yeah.
But, it turns out there's a lot more to it.
Yeah.
So to get into this, we're going to be looking at data going all the way back to 1980.
Okay.
We'll be covering the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. And honestly, some of the trends that we've uncovered have been pretty surprising, even to me.
Yeah. I think when we talk about the stock market in election years, people kind of have a preconceived notion of what happens.
Right.
But as you've seen from some of the data, it's not always as predictable as you might think. Long-term patterns are interesting, but the immediate reaction is often driven by just good old-fashioned human emotion. Uncertainty.
Yeah.
Exactly.
So let's break it down. Let's get into the nitty-gritty here. Looking at this data, it seems like all three major indexes, going back to 1980, have actually averaged gains between Election Day and the end of the year in every presidential election year since then. So that sounds like a pretty reliable post-election bump, wouldn't you say?
It does. But that word average, I think, is doing a lot of heavy lifting there. It means that we've seen gains more often than not.
Right.
But it definitely doesn't happen every single time. And just to be clear, we're talking about the overall performance for the rest of the year.
Okay.
Not the immediate days after the election, which is a whole other story.
See, this is what I love about these deep dives. There's always a twist. So tell me about that. Tell me about the immediate aftermath. What happens in those first few days and weeks after the election?
Well, you might be surprised to hear that all three indexes actually average declines in both the trading session immediately following Election Day and even during that entire first week.
So we have an initial dip, and then the average for the year is actually positive.
Correct.
But that's very interesting that it actually dips initially.
It seems kind of counterintuitive.
Right.
You would think that the market would celebrate the end of all the uncertainty, right?
Okay, we're done. We can move on.
Right. Let's get back to business. But as we've seen, it doesn't always play out that way.
So what's the explanation? Why the dip?
Well, it all comes down to, I think, the market's aversion to ambiguity.
This has been super insightful, by the way. I'm definitely feeling a lot calmer about my own portfolio now.
That's great to hear.
And I hope our listeners are too. So to wrap things up, I just want to emphasize that the U.S. stock market has a remarkable history of resilience. It's weathered so many storms, countless storms, including a lot of really wild elections. And guess what? It's consistently trended upwards over time.
It's true. The market has a way of bouncing back.
So stay the course, stick to your plan, and happy investing, everybody. So we've talked about a lot today. We talked about how the market often dips right after an election those first few days.
Right, that knee-jerk reaction.
Exactly. And then we talked about how overall the market tends to be positive for the rest of those election years.
Yeah, history shows us a pretty consistent upward trend over the long term.
But we also talked about how important it is to focus on long-term economic factors, like you said, interest rates and corporate earnings, rather than getting caught up in the short term, like who's actually in the White House.
Exactly. Those fundamentals are what really drives sustainable growth.
So just to make sure we're giving our listeners, really actionable advice here, what would you say is the most important thing to remember during these kind of crazy, uncertain times, especially right after an election?
Honestly, don't panic. It's easy to get swept up in the headlines and all the chatter, but remember, investing is a marathon, not a sprint.
I love that. A marathon, not a sprint. So instead of checking our portfolios every 5 seconds, what should we be doing instead?
Well, first, make sure you have a solid investment plan, one that aligns with your goals, your risk tolerance, all that good stuff, and then stick to it. Don't let short-term market fluctuations throw you off course.
So it's all about that long game, right?
Absolutely. And remember, diversification is key. Don't put all your eggs in one basket.
Yeah, that's always good advice. Okay, so we've covered a lot of ground today, and I think we've given our listeners a lot to think about.
I hope so.
As we wrap up, I just want to reemphasize how resilient the U.S. stock market has been historically. I mean, it's faced wars, recessions, you name it, and through it all, it's continued to grow.
It's a testament to the strength of the American economy and the ingenuity of its people.
Well said. So, to all our listeners out there, stay informed, stay calm, and happy investing.
Hey, thanks so much for deep diving with us today. Head on over to OVTLYR.com. That's OVTLYR.com to save time, make money, and start winning with less risk today. And we'll see you next time.